NII, we have the gross NPA, which is largely stable. So 0.3% on the net NPA versus 0.27% Q1Q. And the gross NPA too has come in just about around 1.1%. Standalone net profit still stands at higher than expectations. So 11,951 odd crores. That equals to, again, an over 20% growth on a year-on-year basis in terms of profit. So the headline is that they have managed to grow their NII as well as their profit over 20% on a year-on-year basis for the merged entity, which is HDFC Bank as well as HDFC. The gross NPA looks stable, the net NPA looks stable. We will have to go into the details with regards to the agri loans because there is expected to be seasonality this time round. The net interest margins, whether they will sustain at levels of around 4%. So those are a couple of parameters which we will have to watch. But overall, prima facie, based on the numbers that we have with us, standalone NII as well as profit in line with expectations, gross NPA, net NPA, no big movement which has come in for either of these parameters. Mangala.
Yes, as far as these numbers are concerned, they look largely in line with street anticipation. In fact, we had a cheat sheet for HDFC, the consolidated entity earlier as well. There was a mild weakness there, but perhaps it's on account of the company consolidating and moving forward. The stock, after an initial dip, has now moved back to the high point of trade. Perhaps the important thing to watch out for in these numbers, apart from the numbers which have been reported, will be the management commentary on the way forward with regards to the asset quality. Slippage ratio is something that we'll be watching out for. A couple of brokerages estimate around 2%, sub 2% slippage ratio as well. And recoveries are something that we'll be watching out for in terms of some support for asset quality, but no real problems for the HDFC twins. Credit cost and loan growth is something that we'll be watching out for too. We do have with us Ashutosh Mishra, who's the head of research, institutional equity at Ashika Stockbroking, joining in. Ashutosh, no real problems with regards to the reported numbers. Net NPA at 0.3%, gross NPA close to 1.17%. We did have the advances and deposits number with us in the preview that the company had given to us too. So from here on, what are your thoughts on HDFC Bank? What are the things that you'll be watching out for from the reported numbers and in the management commentary?
So what will be the most important things which I will be watched is the liability structure of the combined organization. So we have seen that HDFC Limited as well as bank has taken a lot of restructuring on the liability side in the latter part of the period. So how really the whole liability structure of the combined organization is emerging, that will be the one important point to watch out. Second will be how the bank will take forward their housing business going forward from here, because we clearly see somewhat of mispricing or is there in the segment. So what will be the bank's strategy on this housing piece, which now is within the bank from here? And third will be what type of rationalization or things they are going to see on the subsidiary front. Now these are the active subsidiary of the bank. So these three things will be important point to watch out for me.
Okay. We do have the gross NPA on an absolute basis, which has risen around 6% We have the net NPA, which has risen around 9% In terms of agri loans specifically, Ashutosh, what are you looking for specifically? Because there is expected to be some amount of seasonality which is expected to emerge from the agri portfolio. Overall, what the merged entity gross NPAs or slippages would look like. A couple of numbers if you could share with us.
So surely in every time first quarter normally we see a relatively higher slippages because of agri loan part. That can be the case in this here also. But if you look on a overall basis, we don't find that there is any alarming situation if you analyze the last 5-year annual report data on agri loan portfolio of the bank. So yes, there can be some increase in the agricultural loan NPA in this quarter, but that is a normal business scenario in my view. So I don't expect any major negative from that front.
All right, take that point, Ashutosh. We'll delve into greater detail of the numbers. Abhishek joins in with his first reading. Abhishek, what do you make of these numbers so far from the reported numbers that we have?
Good set of numbers coming in from HDFC Bank. There is pressure on the cost front, but it is across all the lenders that cost of funds have risen. And we had mentioned in our preview as well of Q1 that, interest expense will rise, cost of funds will rise, because from November onwards, we have been seeing bankers raising the term rates or the deposit rates as well. So cost of funds has weighed on the results a bit on the NII front. We are working with a number of close to 23,922 crores. It has come in at 23,600 crores, a miss of about 1.35%, but no taking away from the fact that, operationally it's a strong quarter. Asset quality largely stable, I would say, because Q1 always sees agriculture portfolio, giving a pain on HDFC Bank's asset quality. Despite that, our gross NPA ratio has remained stable at about 1.17% when compared to 1.12% in the previous quarter. Net NPA ratio has also remained stable at about 0.3% versus 0.27% in the previous quarter, and their ROA on a standalone basis continues to remain impressive at and above 2%. So they have reported a profit of 11,952 crores. We are working with a number of 11,433 crores. So PAT is on the higher side because other income has been doing well. Previously, if you take a look, fee income has done well for them as well. So it looks like good fee income would have boosted this time around for the profitability as well. Back to you.
Okay, all right, Abhishek, thanks very much for that. So yes, the NII on a standalone basis is up around 21%. We have the profit, which has surged quite a bit on a year-on-year basis. So that is around a 30% growth in terms of the profitability. But it's to look at it, it is actually, yes, the net profit is up around 30% on a year-on-year basis. So that's higher than our expectations. Prakash Diman joins in. Well, Prakash, largely prima facie based on all of the parameters that Abhishek listed out, it looks like it's a slightly better than expectations set of numbers from the merged entity. But from a stock performance, from buying the stock at current levels and going forward, what the future could look like, what is your take on HDFC, the merged entity now?
So I think you said rightly, there is absolutely nothing to, pick holes in terms of the metrics. In fact, I would believe, what people need to look at from a stock investing perspective is what happens here on. I mean, this is going to be like the base. This is almost ground zero in the new setup with the new entity in the combined form like that. So that's what you need to look at. The commentary is going to be very important. As Ashutosh was also alluding that, the integration on the liability side is something which can be of a huge advantage. Remember, we are in a high-cost regime, which all banks are struggling, and that's where you see the NIM contraction. For whatever, we've seen the last couple of quarters, including Federal Bank for this quarter gone by. But if HDFC Limited and the erstwhile HDFC Limited and HDFC Bank as a combined entity were to get some advantage of cost of funds being reduced, even a few basis points, that's going to be remarkable. So the market's probably waiting for those indications and then probably penciling in a higher, growth rate for them. And then that would mean that with a 2% ROA, you just can get better. So I think it's a great opportunity to buy one of the most formidable balance sheets in the banking space globally and in the Indian context. You can't go wrong with this. So I would believe these numbers tell you that it's just the starting of a new era, which is going to be even better. And this is just a base case of sorts. The numbers tell you everything is absolutely fine and dandy in terms of where the bank stands today.
It's understandable that this quarter will not have the impact of the merger. This is the numbers that have been reported because the quarter ended on June 30th and the merger became effective only on July 1st. Prakash, you said that the market would want to see what happens to the business of the merger, whether costs come down because of the combined might of these companies, etc., or not. But from an investment standpoint, would you want to wait for those numbers or jump in right away after things have happened and maybe take a bet thereafter? Buy first and then take a bet, or wait for the numbers and then buy HDFC Bank?
No, not at all. No, I am not I'm not recommending people wait for the numbers of the combined entity. That's still about 2 months away, and it's not going to be significant to move the needle. 2 months is not anything very significant. But I'm talking about the commentary from the management in terms of how well the integration is completed and it's at takeoff stage. So I think this, as I said earlier, it's a great level to buy into this franchise. There will be so many advantages. I mean, we talk about liability side is just one. I mean, on the network, on the relationship, the new relationship, upsell potential. There's so much that can happen. So I'm quite positive, and that's one of the reasons why the other banks there's a lid on what the other banks' stock performance has been doing ever since the merger has come about. You look at a Kotak, look at a Axis or an ICICI, they've kind of stopped. They're taking a pause. Their prices are not moving anywhere north. But HDFC is going to garner a lot of attention and money. So, yes, you could jump in right away. Unless something is drastically wrong, I don't think you need to change that stance.
And what proportion?
Exactly. What's the risk, Prakash? Because you've listed out all of the whole bullish scenario. What's the risk?
The risk is, when you have integration of two different lines of business, I mean, both while they have a common theme of lending, the asset classes, underlying asset classes are far different. And HDFC Bank also has a significant contribution from fee-based activity. Now, when they focus on integrating the large fund-based activity from the HDFC Limited side, this fee-based franchise should not, come down. For example, I'll tell you, HDFC Bank has the highest number of credit cards in circulation. It is probably one of the second, third largest broking house in terms of volumes and clients. So all of that needs to continue to grow while you digest the large piece of the assets, the fund side. So the fee-based and fund-based activities need to get integrated with both growing equally or better. That integration is going to be a very critical thing, Hector. So the only risk is if there's a delay in that, and that means you lose out on market opportunity. That's all.
You said one can jump and buy. I just wanted to know how much money should one deploy? How much money of their investable capital should one deploy in HDFC Twins? For the Nifty, it accounts for nearly 14% of the weight. Do you think one should ascribe 14% of their portfolio to HDFC Twins as well, or rather HDFC Bank now?
So, of course, they will need to take help from the advisor to ascertain the risk, distinct profile. But, largely, what happens is if you are looking at banking as a sector to allocate, for the overall Nifty, the banking allocation is much more significant. Within that, if you had to allocate, you could go 50% of your banking allocation to the HDFC Twins. So that's where it works beautifully. And you would have a smattering of a couple of other banks, smaller banks maybe if you want. So there's a balance between the monoliths and the wannabes, so that's how you would create. But allocation to banking of to 22% is something which I've seen largely in all portfolios, and it's done well. I mean, banking is one of the proxies to the growth in the economy, so it definitely deserves that kind of allocation for sure.
Okay, quickly, Prakash, we have a whole host of numbers which are coming out from the banking space this week itself, especially on Saturday. Kotak, ICICI Bank, RBL Bank, Yes Bank. Would HDFC Bank set the tone for the rest of the numbers, or do you think that this is set apart?
This is a bit different. The phase of growth that HDFC Bank is at, it's at a cusp of a new entity, a new avatar which it's come into. So it might not probably be that significant or that strong a representation. But I think if ICICI Bank numbers are 80 to go by, they will set the tone for the rest of the sector. I mean, like as I said, Federal is too small an entity to set a footprint for the rest of the quarter's earnings from banks. But ICICI will be the one that I would watch for to set the mood. It's like TCS doing it for IT. ICICI should probably do it for the banking pack going forward.
All right, Prakash, thank you for that. That's helpful and also, gives the direction for the street. HDFC Bank at the high point of trade as we speak. With that, we wrap up on this edition of Halftime Report. So if you've just, tuned in, it's good numbers coming in from HDFC Bank, but Business Lunch will take all the market action ahead.